Hello, I am TG Watkins, Director of Stocks at Simpler Trading, and welcome to today's class. Let's explore some simple tools for high probability trade setups. So, a little bit about me. My dad and I are both pilots, and we're both stock traders. And mostly being a pilot has really instilled a lot of discipline in me, because if you are reckless or don't follow your checklist, you can really kill your account and really injure the airplane as well. Here are a couple of pictures of my dad and I up top. We're up in Utah, Monument Valley, flying around there. We actually stayed the night. You can see it's pretty cold one of the mornings that we were out there. And then the bottom picture is my dad and I were flying around someplace. My interest shaped my trading style, a little bit about me and kind of how my philosophy works with my brain and kind of how I see the markets. I graduated from Arizona State University in 2010 with manufacturing engineering. So I'm very much of an engineer. I kind of have that go, no-go kind of brain. I like to see things kind of black and white. And then from there, I went into finance. I wanted to help people and actually learn more about money and more about investing. And so I became a financial advisor with New York Life. I got my Series 6 and 63, and that was from 2010 to 2014. And from there, I had to decide to break off, go on my own, get back into trading. Is something that I've been doing or dabble around since I was a very young kid. My dad kind of brought me around to a lot of those things. And so I started up Moxie Trader, and I've been doing that ever since 2016. I always like to tell people, trying to get into this, and even when I was getting into this, we're not born being a trader. Maybe some of us have a little bit better knack at it than others, but everybody had to learn the ways of the market. Everybody had to learn what it was like to trade and how the markets worked. And so, as I said earlier, my dad actually brought me around to some of these stock trading seminars when I was younger. So I'm sure a lot of us have probably been to something like this, but can you imagine a 12-year-old somewhere in there? That 12-year-old was me. And I remember, I was trying to grasp actually everything that was going on. Some of it was a little bit over my head, as you might imagine. But at one point, I asked the instructors that were up there, and I said, "Is this really possible? Like, can people actually make money from doing this?" And they said, "Well, absolutely. Nobody was born a trader. We all had to learn how to do this." And that was one of the strongest things that really stuck with me, because it told me that if we had to learn how to do this, then it was teachable, and then I could learn it, and I just had to figure out how to do this. And so that was something that really helped me when I had some of the rough spots through my trading career as I was starting to learn this is other people can do this. It is possible. There is an answer. And so that was really a big motivating factor for me. And what you'll learn today is how to use average true range plus the Keltner channels, which really helps find opportunities and learn how to cash in at the right time, and how to find the correct low to buy using stochastics, and then John Carter's favorite indicator, the squeeze, and how to use it with your trading to find opportunities before they launch. It's one of his favorite indicators. And then how to find where the big players are by using volume. That's very crucial that we need to know what that looks like. And then how I tie it all together with the Moxie indicator to find powerful trades. So my proprietary indicator is the Moxie indicator. You'll be seeing it in some of these slides. And then towards the end, I'll show you how I incorporate everything and bring it around full circle, especially with the Moxie indicator. Now, ATR plus the Keltner channel, we'll kind of go through this. I know it's going to be maybe a little mumbo jumbo, but the definition of it is this, and then we'll kind of get into the actual application of it. But ATR is the average true range, which is the range of a day's trading is simply the high minus the low. Okay? Then we have the true range, and the true range extends it to yesterday's closing price if it was outside of today's range. And then we have the average true range, and the average true range is then the average of those ranges over the course of a specified number of days or time, typically 14 days. Now, this is the actual chart of what ATR looks like. This isn't anything I particularly use, and again, this definition of this is a little wonky, but we'll show you what the application of it actually looks like. So we go over here, and now we incorporate ATR with the Keltner channel. Now, the Keltner channel is a volatility-based indicator composed of 3 lines. The middle line is an exponential moving average, typically at 21 or so, something like that. And then the outer lines are typically 1, 2, or 3 times the ATR. So what I have here, I know it looks like a lot of lines here, but you'll see the center line right here. This thing kind of squiggles around like that and follows generally the middle of price. From there, everything is then extrapolated. You have the ATRs which gets factored into the Keltner channels, and then I have them kind of color coded a little bit. We have green on the top and the bottom, so you have your plus ATRs and you have your minus ATRs. So that's the +1, -1, and then you have kind of this other color that I've made it, and that's your +2, -2, and then you have the outer one, which is +3 and -3. So as you kind of look through those, this is basically the columns, or basically the columns that price generally tends to trade within. So we'll get a little bit more into that, but just so you know how those are created, what they look like, and how they operate. And this is really the crucial part right here, that typically price does not spend much time outside of the third ATR. Now, the way that I have my particular chart set up is I don't use the middle moving average to generate the ATR, to generate the Keltner channel, and I don't use the 1 ATR. It's too close. It doesn't really matter to me. What I like to do is I add the second and third ATRs. And I have here, you can see I have the second ATR as kind of a dotted line. It's kind of like a heads up, things are starting to get a little bit far outside of their bandwidth, outside of their move. You can see I have it top and bottom as the dashed line. And then the third ATR is the solid colored right here. It's gray. I keep it solid, and I like to have them kind of faint. I don't want them to be too strong because really, for me, I prefer to see the inner moving averages like the 8, the 21, the 50, and so on. But I use them as barriers because if you think about if you're driving down the highway, you have the guiding lines. Maybe you have the white dotted lines, and you have the yellow outer lines that are solid. It's kind of the same idea. It helps kind of tell you the lanes at which price is going to flow or stay within. And so not often does price go outside of the third ATR. It can kind of run along it, but if it pops out, usually wants to come back in. You can see that right about here, and then here as well. And then you can see here, and then even to the downside right there, and then back to the upside and downside again. Once you start incorporating these, you'll really start to see that price generally stays inside of the third ATR. All right, so now here's another example. You can see examples where price hits the third ATR, then comes back. Or, if there's really good momentum, if there's a lot of buying or selling in certain cases, you'll see that price just flows along the third ATR. Maybe sometimes it gets a little bit too far, but kind of needs to come back in. That is perfectly acceptable. Definitely means that there's good strength, whether it's to the upside or to the downside. But we do need to make sure we discern the difference between when price just hits it and wants to come back, or if it's going to be able to stay sustained for a while, but eventually it's going to come back in also. All right, now the third ATR can be very useful for knowing when a stock is overbought or oversold. So you can see here, overbought, price kind of went outside of the third ATR too far. This was oversold, went outside the lower third ATR too far. Right here, we had a little bit too much, pulled back, and then started going really far out, really far out. So those are the things that we need to be aware of, and still to the downside. Now, caution is warranted. Either caution is warranted if you're in a long and it really went up too far, or opportunity is present. Again, if it depends on which way you're trying to go. If you're trying to buy something, then we may be actually looking for an opportunity when price is hitting the lower third ATR. If you're trying to short something, well, then maybe there's an opportunity here when it starts hitting the upper third ATR. It just kind of depends on what your strategy is and what kind of a trade you're looking for. Now, when price moves outside of the third ATR, it's a good place to cash in if the trade is in your direction or possibly an entry opportunity. So like I just said in the previous one, if you're short, it just depends on what direction, but if you're short, you can see that when price suddenly drops out and goes way beyond the lower third ATR, might be a good place to kind of take some off, take all of it off, cash in some profits, because if I've shown enough here, you can see that price doesn't stay outside of the third ATR too long. And then if you are looking actually to go long and you see that price drops, then perhaps that actually is a good dip that can be bought, because right here you can see price hit the third ATR and then it started to reverse. Now, this is just kind of the first of some of the indicators that we have here that'll help you put it all together and figure out where those high probability trades are. All right, here you can see where price behaviors of both interact with the third ATR. So we have where price goes too far outside of it and needs to come back. And then you can also see where price runs along the third ATR right here. And then you can see it has one last little jump up outside of the third ATR, too far, and then it comes all the way back down there. So you do need to be kind of aware of context and use some other indicators to tell you, which situation are you in. Are you in this one where it's kind of an initial run, wants to pull back and then continue, or is this going to be some sort of exhaustive blow off top of sorts? But it can price, stocks, tickers can actually exude both personalities in the same situation. Here's a pretty good example of that. All right, now on to the next indicator that I like to use. It's called the slow stochastic. So I'm just going to read this, then I'll kind of get into it. The slow stochastic oscillator is a momentum-based indicator that shows the location of the close relative to the high-low range over a set number of periods. The indicator can range from 0 to 100. As you can see here on the side, we got 0 to 100. Now, I do have these arrows right here on the right, 80 and 20. Usually this is oversold below 20 and overbought above 80. So just kind of keep those in mind. That's kind of the oscillator and how we use it. The closing price tends to close near the high in an uptrend and near the low in a downtrend. So if you're in a downtrend, the average closing bars tend to close lower in their range, and that is what the slow stochastic is measuring. The difference between the slow stochastic and the fast stochastic oscillator is that the slow incorporates a slowing period of 3 that controls the internal smoothing. So it's a smoothing mechanism, and then it also has 2 moving averages. And we use that so that you can tell when one crosses the other. It's very similar to if we use the, say, 8 and 21 EMAs on price. Your trend is, say, up if the fast moving average is over the slow moving average. Your trend is down if the fast moving average is below the slow moving average. Same concept applies here. And so when we're looking to, say, buy an oversold situation, it's good to wait until the slow turns up through the fast. And that's what we're looking for. We want to see the moving averages on these stochastics actually change. Now here in the bottom right are the general settings for the slow stochastic that I use. So if you want to take a screenshot or anything like that, then these are the parameters that I use. All right, so here's another one. I found that the slow stochastic to be best at identifying bottoms or reversals in conjunction with my other primary tool, the Moxie indicator, as I covered earlier. I primarily use the slow stochastic on the daily and secondarily on the hourly time frames. Now, this can be used on any time frame. It can be used on the monthly, the weekly, the 15, the 5 to 2, whatever. It depends on your trading style. So any of these things, any of these concepts that I talk about, most of these I don't actually have them designated whether it's on a daily or hourly time frame, because the concepts apply to whatever time frame you're using. So, this could, for all intents and purposes, be a 2-minute chart we're looking at, and the idea would still be the same. So what we're looking at is we want to see when the slow stochastic down here gets into the oversold range, and we want to see that it starts to, tell us that its price doesn't really want to go down any further like that. And then we add it in conjunction with the ATR, and you can see that in this situation, price went really far below the third ATR. The stochastic got pegged and just started going flat along there. And then, as I said, with the Moxie indicator, I have my positive divergence. We'll kind of get a little bit more into that a little bit later. But what you can see is we got price down, the Moxie indicator up, price went outside of the third ATR. We have the stochastic is down in the oversold range and going flat despite price still going down. And you can see at that point, that's when price started to actually turn around and then go up for the time being. All right, so when the stochastic gets into the oversold range, it's good time to start looking for buy opportunities. It helps to wait till the fast crosses up through the slow. So that's what I covered just the other slide. Now, what you might be asking is, well, what about overbought? The oscillator does work similarly in that way, it is in the overbought area, but I tend to find that it works best on the oversold. I think part of the reason is the theory behind the way that the market works is as price can go up for a long time, but bottoms tend to be a moment in time. Bottoms tend to be like a V bottom. Tops can be a little bit messier and longer and just keep getting pushed. So I really use the slow stochastic just to kind of find bottoms and reversals. But what you're seeing here is when I got the arrows down at the bottom, but you can see that price didn't actually turn around. These arrows are actually lined up. So price didn't actually start to bottom and turn around until the fast moving average on the stochastic went over the slow moving average. So it's the green crossed over the pink or the purple, whatever color you want to look at that. That's when you knew that basically the direction of price for this time frame started to actually turn around. And so it's not just necessarily good enough that the stochastic is in the oversold range. You want to make sure that the slow moving average or the fast moving average changes up through the slow. All right, other formations to look for with the stochastic at oversold levels. Now, these are kind of the three most common, generally the best standalone patterns that I've found to work with the slow stochastic. The typical one, double bottom. We see that with price also. We see it with a lot of other things. Double bottom is just a thing throughout the market that works really well. And you can see here, each of these are lined up right here and right here. And you can see we got the double bottom, and then we also have a double bottom of price. And then when it started to go back up when the fast got over the slow, and then it started to move from there. So just keep an eye out for that kind of pattern. And then we'll get into the next one. So here's the persistence at the low range. This is very similar to the first one that I showed when we got into the slow stochastic. Now this one, what you'll notice, and this is the kind of the key when it comes to the persistence at the low, is that price will just keep going down and down and down, but the stochastic just gets pegged at the bottom, just kind of hangs out there. Now, it can't necessarily be used to figure out exactly when price is going to go back up in this situation, but what it's actually telling you is that there is a lot of downside pressure, and that it's likely that when it turns around, it's probably going to pop pretty significantly. It's telling you that it's way, way, way oversold, and so it's actually a fairly good setup when things want to actually turn around. But you got to use some other parameters to figure that out. What you'll see here is that this too, incorporating the Keltner channels, it had been riding the outside of the third Keltner channel all the way down, that third ATR band. And then the stochastic was all the way flat. So there's kind of some divergence. You can see that kind of, in this case, positive divergence. Once again, notice when price actually did turn around. It's when the fast moving average got back on top of the slow moving average right there. And then the next opportunity to buy and to look at this price turning around, a little bit of a pullback here. And you can see here, we got a little bit of a double bottom right there, and then in the oversold range for the slow stochastic. So you're starting to see how a lot of these come together and actually start adding layers, and different formations come together to tell us how price is going to move and when we have a good likely opportunity to get in. All right, so another one here is higher low divergences. So similar to a double bottom, but the second bottom, the second low, is actually a higher low. And this is what you'll see. It's a formation of divergence that I kind of look at. You'll see that price went level, but look at the slow stochastic. Its last low was actually higher. And so that's something important to note, that the direction, the kind of the internal direction, because remember the stochastic measures the closing area, the closing range of all the price bars. So what this is telling us is that even though price generally in the range of the bars was flat, it was actually the bars where they closed higher. So that's something, it's a good visual representation that perhaps the direction and the momentum has actually changed. All right, now we're going to get into the squeeze. Now, John Carter is world famous for the squeeze. Some of you may or may not know exactly what it is. We're going to do a little bit of a dive in here, and we'll get to that. So the market is said to be in a squeeze when the Bollinger Bands go inside of the Keltner channel. The indicator will produce red dots when the situation occurs, signifying a period of market compression. So once the Bollinger Bands move outside of the Keltner channel, then a squeeze is considered to be fired, and that's when it's starting to actually expand and momentum is starting to go to whatever direction it's going to go. So let me kind of go back, break that down a little bit. We are now familiar with what a Keltner channel is. Now this is like the one Keltner channel, or the 1.5, something tight, like that. So we have our Keltner channels, we have the moving average in the center, which is for the Keltner channel, and then we have the the +1, +1.5, or the -1, -1.5. Now the Bollinger Bands are the bands on the outside that I have colored purple. And they start to move in based on volatility and an expansion or contraction of price movement. So a squeeze, which remember is basically just a consolidation of price, is determined when the Bollinger Band comes inside of the Keltner channel. You can see it right there, and then you can see that is when the squeeze, which is free, goes from green dots, which means not in a squeeze, to red dots, which means in a squeeze. And then you get a period of time of this compression where price kind of just hovers around inside here, and then it starts to expand and take off. And when that happens, you can see that the Bollinger Band starts to cross outside of the Keltner channel, and then that is when the squeeze is considered to be fired, and you start getting back into the green dots. So let's kind of dive into that a little bit with some more examples. All right, now for my trading, the squeeze is used as a way to communicate that a stock is in a consolidation area. I don't use the squeeze as an entry signal. Instead, I use the MOXY, moving averages, and the stochastic to kind of help tell me exactly when those periods of time are. The squeeze can exist for a very long time. It can be short, it can be long. It's just trying to tell us that there is a time or a period of price consolidation, generally sideways movement, and that price likes to go sideways before it starts to expand. Think of it as kind of like resting or building something up. And so what you can see here is that we've got the squeeze right in through here, and that I'm just kind of stacking on top of all the different situations that we've now used. So we know we have a squeeze, so we're expecting that whenever this thing starts to actually start to move, it's going to move pretty well because it came out of a point of consolidation. But how do we know when? Well, we can use a couple things. Notice here, we have the slow stochastic, and what did it do? It actually has that lower high, the divergence, even though we had a double bottom on price. So that is one of the slow stochastic indications that I just went over. And then what you can see here is we've got the MOXY indicator. May not mean too much right here until I actually get to it, but this is what I call a trampoline move. Price over the 50, bouncing off of it, and the MOXY indicator above 0. And then you'll see when price actually starts to move, like right here, when the squeeze actually fires, it's a little bit too late. Let me kind of clean that up for you. But what I'm getting at here is when the squeeze actually fires, which is where this second arrow is, you've kind of missed a good entry, right? You're entering here as opposed to here. And so it's good sometimes, as long as everything else works out, to actually enter during a squeeze, because a lot of times by the time you enter when the squeeze is fired, it's already started moving because it's already starting to expand outside of the Bollinger and the Keltner channels. All right, so think about the squeeze as the calm before the storm. And since it represents an area of compression, price can fire in either direction. So that is something very, very important that you all need to understand, is that it's just an area of consolidation. It can fire to the long side, it can fire to the low side. We just have to figure out which way it's going to do that. This is why you need other tools to determine which way that will be. In this particular situation, you can see that the squeeze, started to happen and fire a few times, and price, you can even see it, was just going sideways, but then it started to fall apart, really break down, and then continue on down and down and down in a big way. So we need to just make sure we know which way it's going to go. All right, here are a few more examples. So the squeeze can last for quite some time, and often the longer the squeeze, the more powerful the subsequent move. Think about, we talk about basing patterns, right? That maybe the longer something bases, the more volatile, the bigger the move, the more, the stronger the move that's going to be outside of it. The squeeze is essentially the same thing. That you can see here that the squeeze was quite some time, and there was a big move, in this case, to the downside. Over here, you can see that there was quite a long squeeze, and then it fired significantly to the upside, and then we got a little bit more over here, and I'll show some more examples of that as well. All right, either way, the moments of consolidation and quiet are opportunities to get in as a move builds. That's kind of what I touched on earlier, is that you look at these things as areas to kind of get in while things are calm. If you're trading options, then things will calm down, the volatility will kind of calm down. And you can see here, there was a little bit of a squeeze and then a move. And then right here, you got a bit of a squeeze and then a move. And then over here as well, a little bit of a squeeze, and then there was a move. And yet another squeeze, and then a nice big move right there. So you look at squeeze as opportunities to get in, and then use your other indicators to figure out exactly when it's going to take off and when the right opportunity is to get in for that trade. All right, so now we're going to get into volume. Volume can be a good indication of conviction for buying or selling. So we need to make sure it can work both ways as well. When a stock is being accumulated by big funds, it can be hard for them to hide their volume footprint, so we look for that and follow them in. Now here's another example. You can see A lot of times volume will really kind of be around earnings. So that's why I left the earnings symbols on here, because it's important to know what's going on. So perhaps a good earnings report came out and something exciting, or they had good numbers, whatever like that. And you can see that there's a big rush of volume that came in along with price. And this is something that's very common. You want to make sure that when you see a big move in price, you'd like to see a big move with volume, because if there's a move with price but no volume, then that might be a fake move. And it's like, okay, not a lot of people are following in, and it could be unsustained. But when you see a big move happen and you see a lot of volume come in, it means there's a lot of conviction. That means there are a lot of traders wanting to go in. There's a lot of money going that direction, and people are buying up the stock, and it will help support the thing and keep it going for quite some time. And what you'll see here on this one is there was a lot of volume that came in that one, and then you can see later that more volume came in on the dips and more volume came in points of consolidation and take this thing off. Now, you do need to be very aware that this still can actually happen to the downside. So distribution volume, right? For whatever reason, maybe something changed again with earnings. Maybe this time it was bad news, like the good news that they got from the first one didn't last. You can see this thing topped out, started to fall down, and boy, we got some big volume back down to the downside as price continued to go down. So when you start seeing something like that, if you're going to go short, great. If you're long, then maybe you need to get out and realize that the conviction on something like this is then to the downside. All right, but you need to be aware of large volume at the top of a price, as it could mean a lot of selling. So we'll kind of run through this one. You'll see that for this one, you had earnings, again, big volume onto the downside, so it's likely that it's going to keep going down. Now, as you can see, when price finally does kind of hit that bottom and it starts to consolidate, it starts to build a base, then you can see when price turns around and you actually start seeing a pickup in volume, then that's accumulation volume. Once all the moving is done and it's starting to level out and turn up and there's good volume, accumulation. So once again, then you have earnings, and you can see that there's a lot of volume coming in right there. And then look at the volume right here when price came back down and tested that moving average. A lot of volume right there. That's something to really pay attention to and be aware that this thing is probably going to go for a little bit. Now, I do like my moving averages. I do really appreciate how they work and how a lot of other traders or institutions look at them. And what you can actually see is right here that price ran right into this 200 moving average, and then you can see that there was a pretty big, large footprint of volume of people selling right there. It makes sense. There was a moving average right there, and then it got knocked back down. And then what you can see is, just like in the previous slide, price got back up there again. Guess they didn't like it. Maybe something else changed, and you can see that there was a large influx of volume, most likely distribution volume, because price couldn't hold it and started to come back down. So these are the big footprints that we want to look at. I was actually just doing a trade last week that, as I was going through, I noticed the same thing after earnings. So it just had earnings, and then there was a lot of volume that came in about 2 or 3 days just following earnings, and I thought, ooh, I think there's going to be a good trade. And sure enough, that thing took right off, and it's probably going to be sustained because it's got a lot of volume that has changed. All right, now here's another one to be looking at. So strong volume while price moves in a direction is the sign of combined support. Same goes for the downside. So we kind of been covering this a little bit, but what you'll see is, look here on the very bottom left of this. Do you see how there's very little volume overall in general? And then something happened. Look at how much volume has actually started picking up in general, just overall. And these are some of the things that if you're going to be, say, a investor, more than maybe a swing trader, but somebody who actually wants to buy and hold a stock, and what you're looking for is institution accumulation. And what you want to see is when a stock goes from mediocre volume of some sort to sustained larger volume, and especially when price is starting to go up, you're like, okay, I think some institutions are on board and they're starting to accumulate this thing and actually start throwing their footprint around. And then you can see what happens. You got earnings, apparently good news, price jumped up. Look at all that volume that comes in, and clearly this thing is going to keep getting sustained. And you can see that there are large amounts of volume that have come in at other opportunities for them to buy, and it just keeps going on up after that. I will show once more that you can see that the volume, even though it was larger here, look how much this consistently sustained right over there. And I believe the next slide is going to be showing something like that as well. Yeah. So noting when a stock's average volume increases, and stays strong is a key way to know that the stock now has investors' attention. The benefit of that depends on which side of the trade you are on. Now, this idea will work to the downside as well, as I show you here, whereas the previous one was to the upside. So note that just the overall daily or hourly sustained volume on this was kind of low. So on the bottom left of the screen, kind of low. You know, whatever it was, it's relative, but yeah, it was one level. And then after they had earnings and some news came out, or whatever this point was, big volume on this down move right there. And then what you'll see is look how much higher the volume bars were all the time after that. There is a lot of volume right there. And you know what? Price is going down. And what that's telling us is that something's going on. Maybe those institutions are actually getting out of this stock, and you need to be aware of that because you may not want to be in it. So that is something to really look for. So whether it's accumulation or distribution, look at the overall longer term volume size and see if it persists. All right, now we kind of come full circle and we put it all together. Now let's see how each of these tools that we've learned about can be applied for a great entry. Now this is where I'm going to be talking a little bit more about the Moxie indicator because it is the indicator that I use, that I built, and I love it, and I just can't do my trading without it. So how we set this up is you'll notice that we have, here's our overall double bottom, and we have now our Moxie divergence right here telling us that the internal pressure and momentum has started to kind of move up. Think of it similar as the higher low stochastic situation on the double bottom situation. Let me show you one more thing here. You can see the squeeze. Let me point out, notice that that squeeze actually fired to the downside. So very important to know which way this is going to go. In this case, it seemed to be relatively easy to know which way it was going to go because price was underneath the 50 SMA, or that moving average in this case. So price came all the way back down there. Then what you'll see here is notice that the stochastic, even though price had been going down, basically falling off a bridge right there, notice how the stochastic was pegged and very persistent at the oversold situation, oversold level, below 20. And then we hit the third ATR. So you can see all the description that I have here, that the low of the stochastic, the third ATR, we also hit this previous low. We've got Moxie price divergence right there, and then price starts to actually move back up. So what you can look at is right there is the turnaround point. So things start actually working pretty well, and then it needs to come back down and do a little bit of a test. And here you can see price testing the 50 SMA, and then it continues on up after that. Now you can see here I show you a couple opportunities. There's a little blip on the radar for the squeeze, and then you can see there's another one, little squeeze, and another little squeeze, and another little squeeze, and each time that's a good opportunity to kind of get in right there. It's a little bit of that calm before the storm we talk about right there, and then right there, and each time it keeps moving up after that. Just be aware that the squeeze is just telling you it's an area of consolidation, so it can go long or short, and it looks like towards the end of this one it started to consolidate before it went short, and I guess that was the end of that move. All right, so now we'll see a little bit more. In this one, you'll see Moxie divergence. This is the first thing that we kind of start getting into. So price down, Moxie indicator up, and then you can see that price was at the lower part of the stochastic. So you can see here, here's that higher low situation. There's the double bottom. Here's the higher low for that last stochastic. You can see the same thing on this one. Here's the double bottom for price. Here's the double bottom for the stochastic, and each time price moved up for each of those. Now again, you need to know context. You need to know that yes, this can be, let me kind of circle that, yes, these can be trades, but you need to understand that, is this going to be a long-term swing trade, or is this just going to be a bounce and a downtrend? This is where you start factoring in some other things like moving averages, your other indicators, and figuring out what kind of trade that this is going to be for you. But there you can see, here's your higher low for the stochastic, here's your double bottom for the stochastic, and then here's just the oversold area. And then again, you wait until the fast goes over the slow for the stochastic to get back in. You can see each of the arrows that I have pointing out those opportunities. And then each of those as well, the stochastic and the third ATR also line up. You can see right there, price hit the lower third ATR, and then you can see here, price hits the lower third ATR, and everything is pretty good on those situations. And then that's how you get price to turn around. And then, as I said earlier, price down, Moxie indicator up, and then you get the Moxie price trigger, test of the 50, and then that is when price really starts to take off. So we got all that, and then, oh yeah, forgot to talk about here, sustained large volume. So what you can see is just kind of in the background, I had a lot of writing on top of it, but notice how there was a lot of volume that came in here. What was right at this double bottom low third ATR point, and that actually helped say, I think price is going to turn around. Yes, price dropped, but look, volume was starting to pick up once actually price went level at that low. And so that was telling us that that was accumulation volume. And then you can see here, when volume started picking up again, that this was a good opportunity as price was starting to get through that moving average in particular. And then even after that, take a look at this, you can see that the volume was very sustained. You see how this volume right here was much larger than this volume right here. See how low that was? So there was a big difference. This was a huge, huge accumulation turnaround. You can see just how much volume that there was compared previously when price was turning around. So this one, in this case, was doing a very, very good job giving us a lot of indicators, a lot of indication that price wanted to turn around. And boy, this thing was sure going to take off, wasn't it? So yeah, that looked pretty good. It had all the different facets and features that we use for the indicators. All right, now here's another one. This is the daily view on TIVA, which incorporates every tool and method that we've discussed so far, including some increased volume on the exit as price hit the moving average overhead. So let's kind of walk through this one again. So what you'll see is kind of that initial bounce right here. Price hit the lower third ATR and then bounced, but we're still in a downtrend, so price kept going down. And then you'll see the next opportunity. Price hit the lower third ATR. You can see that the stochastic also hit the lower 20, the oversold range, and then bounced. And then what we can see on this particular one, you can see price down. We had the Moxie indicator up, telling us the internal momentum, the internal divergence had started to change, and price was going to go back up. And then, right as that was starting to turn right here, you can see that there was a lot of increased volume right there. So again, like I talked on that previous one, this was price coming down to the bottom, starting to turn around. This was accumulation volume. Again, it seemed to have happened right after earnings, so that was kind of telling us that maybe some news came out, maybe they're turning the ship around, and some different business practices are actually happening, and that maybe they're making a profit at this point, something like that. And then we can see, here's your overall double bottom. Price came back down to test the low. And what happened at that point? You can see that as price was coming back into this low, you got a double bottom right there, and here's your divergence on the slow stochastic. And the second low right there was the second low right there for the double bottom, and price started to turn around. Now, one thing I will allude to, as you can see here, I talk about the Moxie trampoline move. That is when price dips below the 50 SMA and the Moxie indicator stays above zero. It's one of my best setups and one of my best trades, and I'll show you a couple slides after this that really highlight that. Now, getting back to the high probability indicators that we use, you can also see price came right into this moving average, like downtrending moving average. Price came right up into it and then got rejected a little bit, and look, there's a lot of volume. So there are a lot of people who also saw that that was a moving average that was in a way, and they were just taking this trade here as price was, big volume coming into price. And then when they saw that it was going to hit this, big volume on the way out as well. And that kind of sank price for a little bit. So that's kind of how we walk through that. Let's go on to the next one. All right, so the next step. This is where I'm going to showcase the Moxie indicator a little bit. As I said, it is the tool that I use. It's really the one and only tool that I need to trade. It's my most important setup, my most powerful setup, and for warnings as well, is the trampoline move. Now in this case, this is the hourly S&P. So if you ever want to go back and look, maybe you can kind of figure out where this was. It was a little while ago. Hourly S&P. Now the trampoline move can be a regular trampoline move, which means a movement to the upside, or it can be an inverted trampoline move, as we're showing here. And this is why I say that we have the most powerful setup and warning. And so it depends on which way you're talking about. I say warning because I typically trade long, and so we want to make sure that we know when something like this, like when price is really going to get hammered and turn over. And essentially, the inverse trampoline move is when price is over the 50, which is over that magenta colored moving average, but the Moxie indicator is below zero. And you guys, I can't make this stuff up. It happens time and time again. You'll see right here, price over the 50, and the Moxie indicator below 0. So this was a really good example that I could show that twice in rapid succession that there were these setups right here. Now, if you're a short trader, hey, this is heaven on earth for you. If you're just wanting to go long and want to protect your money, make sure that you don't get run over by a big move to the downside, then this is an extreme warning for you. And this is why I think that the inverted trampoline move is something very important to know about. All right, now let's show a little bit to the fun to the upside. Now, I'm sure we all know that back in the day, Tesla, how it was really doing, and that has a crazy move. You can see here that this was all the way back to the $230, $250 range. And what I wanted to show you is that that move, in addition to having good earnings and a lot of news changing around, but that move started with a trampoline move, a Moxie trampoline move. And what you'll see is price was below the daily 50 SMA, and notice that the Moxie indicator was above 0. And that was a big, big move that really set that thing up. I mean, you really got to think about like a trampoline price, jumping down and then getting thrown back up by that trampoline. Now, Square did the same thing, and it also had a very, very good move after this. So you can see price dipped below the daily 50 SMA. Notice that the Moxie indicator stayed above 0, so we knew that was happening. We knew that there was a high pressure situation, and so that threw price right back up. And at the time that I took the screenshot, you can see it was here, but boy, it's way up there at this point, right after this one. So if you want to go back and take a look at that, that thing sure moved. All right, then another one that I'll go over, and then we'll kind of wrap it up here. All right, so the Moxie indicator is a proprietary momentum-based indicator that I built and designed, worked with, and came up with all the rules. And it's not available through Thinkorswim, so I just want to let everybody know that if you go looking for it, we provide it. This is Boot Daily, and kind of the process for how this works is you see price going down. You'll see the Moxie indicator went flat, and then you can see price went flat, and then the Moxie indicator started going up. That's telling us that the internal momentum, that internal pressure, is actually starting to build to the upside. So it's giving us a good heads up, especially if you are short, let's say short this trade or this trend, you might need to start looking to get back out. Here's your Moxie price trigger. Yeah, it happened on earnings. And then we see a little bit of a tap of that moving average right here. And then once again, here's that trampoline move. See how price dipped below the daily 50 SMA and the Moxie indicator stayed above 0. And we'll look at the move that came out after that. Now, just to show that it does work for the exit as well, you can see price kept going up and then level. Notice how the Moxie indicator went flat and then down. It's basically the reverse of this right here for an entry. Hopefully you see that. So it tells you when you need to get in if you're going to go long, and when you need to get out if you're in a long position. And then you can see here's your Moxie price trigger, and then price started to fail after that.